Stocks had their worst day since June 11th, with the S&P 500 down 3.5% and the NASDAQ down 5%. It reminded me of the old Ron Burgundy quote or GIF from Anchorman. That escalated quickly. I had a class this morning, and at the time the market was down 0.5%. Get out of class 2 hours later, and markets are down like 4%, and I had no idea what was going on. So a little bit of a surprise there, particularly from a lot of those work from home companies that had been leading the market higher up until this point. So we'll take a look at all the damage, see what happened with the VIX being up 26% today as well, and seeing if it changes our posture on any of our major indices that we track here in this video. Then we're going to get into our trade application example, where I wanted to feature a consumer staples company that broke out just this week, pulled back a little bit today, but might be offering a nice opportunity for a sold put. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 3rd, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe. While you're over there, check out our description area so you can sign up for our email distribution list to be alerted to whenever we post these daily videos, in addition to also letting you know which stocks are considered overbought and oversold within the S&P 500. And that would have been a very helpful email last night, considering we had 3 out of the 4 major indices with overbought cluster signals. I'm sure there were a number of stocks that also would have been considered overbought last night. So if you're not taking advantage of our daily email distribution there, make sure you sign up. We're also heavy users of Twitter. My handle is @BrandonVanZ. Would encourage you to follow me there, in addition to clicking like and retweet if you get value out of these free daily YouTube videos. Lastly, we have a presence on Facebook as well. Feel free to join our group at the web address you see embedded in the logo in front of you. All right, let's dive into our charts here. It's been a while since I've had this chart pulled up. You guys will recall, if you've been with us long enough, that this is the chart that I traditionally would have pulled up time and time and time again back here in March and April. I generally start my process with this chart if we have more than a 1% day in either direction. And just as luck has had it, I really haven't been doing the Market Outlook videos when we've had 1% moves more recently. Remember, I only do the videos on Tuesdays and Thursdays. So as you can see, this is a pretty dramatic candle we have here off to the right-hand side. For those of you newer to looking at this chart, it's 6D. For those of you that are premium members following along at home, this particular chart will give us a sense of how aggressive any one day was, and gives us an easy way to compare and contrast versus recent price activity or even going back several months. So this big red candle here signifies that we were down over 3%. When it breaches kind of this fuchsia or pink horizontal line here, that is the 3% level. So not only did we get a 1% pullback, which would have been the blue line there, we also got a 2% pullback, which is the orange line, and then a 3% pullback, which was the fuchsia line. And as you can see, the last time we had a sell-off that was this aggressive would be right back here with this other big red candle, and that would have been June 11th. And you can see it was quite a bit worse that day. In fact, that day was like a 5% plus pullback day for the S&P 500. So we weren't nearly that bad, but we did eclipse all of these other fairly large candles since then. So a pretty big pullback. As I mentioned in the intro, the VIX was up 26% today. I know you don't really look at the VIX because itself is a percentage of how much it's up on a percentage basis, but just gives you a general sense of that this was an outsized type of a day. And you can see down below here that the VIX now finds itself back at 33. Remember, it wasn't too long ago, right back here, where we were cracking below 20. And so we've come a long ways here in a very short amount of time. That below 20 reading was just here at the end of August. So here we are a week later, and we're above 30, just like that. Remember, that hasn't been completely out of the blue. I know David has been sharing that information on Twitter with you guys as well, that the VIX in some of the more recent sessions had been up at the same time that the stock market was up. And days like today remind us why it's important to have balance in our portfolios. This move today should not have blindsided any of you that are premium market scholars that attend multiple classes. Even here in this very video, you guys will know that 3 out of my last 5 trades have been bearish trades despite having wildly bullish markets. And I believe David's trade last night with Apple was also a bearish trade. So it's not as though we are loaded to the gills with nothing but bullish trades here. We've actually been taking just as many bearish trades recently as bullish trades. And it's not because we knew today was going to happen today. We just knew that we were getting out ahead of our skis. Some of you will recall just on Tuesday when we had a situation where so many of those work from home stocks were up so dramatically. Remember, that was the day when Zoom was up like 40%. And I was saying how remarkable it was for the trend trading portfolio that I managed for another premium class, that it was up 5% in one day. And I didn't recall the last time that had happened, particularly in that circumstance where it was not a dead cat bounce, right? Back in March and April, we had some really aggressive days for the market as well, but that was immediately following a really, really nasty sell-off. What we experienced here a couple of days ago was markets at an all-time high, and then having a 5% move on your entire 25 stock portfolio. It's nearly unheard of. It gives you the impression of almost like a blow off top type of a situation. Now, I'm not here saying that was the blow off top. I'm saying that it got way ahead of itself at that point when you have a move in the market like that. So that's why on Tuesday I did a bearish trade in this video, or part of the reason behind that. Today, interestingly enough, that exact same portfolio, that 25 stock portfolio, was down almost identically to the amount that it was up on Tuesday. And our account value is right back to where it was on Monday. So despite today's ugliness, we have to keep things into perspective and remind ourselves that yes, the markets were getting rather overheated to the upside. When we saw kind of ridiculous things like Tesla going up 55% since it had announced its stock split, and other very peculiar things going on, it just was a market that felt a little bit unhinged. So it's important once you get to moments like that to start participating on both sides of the market to balance things out with the bearish trades that I've been doing here lately with AbbVie and CVS and the Office REIT, and I think last night David did the Apple bearish trade. So it might not feel right at the time when you're doing something like that because you're looking at everybody else making money around you on the long side of the market, but you feel a little bit better about your situation if you at least have some bearish trades on when you have a really ugly day like today. So I know a lot of you are really good about that and having some of that balance in your portfolio, but for the rest of you, some of you might be just getting started and just starting to learn the process of trading and investing. You might not feel as comfortable on the bearish side of the market, and that's where hopefully you can pick up a couple of things here and there during these free videos. And for those of you that, of course, want to take it to the next level by signing up for our premium services, we do, of course, practice a lot of bearish trading in those classes as well. To give you a sense of how bad things were here today, let me come on over here to Market Watch and then Visualize. So here's the heat map of the S&P 500. You can see that there's a sea of red, and the way that you kind of read this is the bigger the squares or the rectangles, those are the larger market cap companies. And remember, the theme of this market for the last couple of months has been the massive outperformance of mega cap tech companies. And so those companies have grown by leaps and bounds in terms of market cap. In the case of Apple, it's now a $2 trillion company, even after today's 8% pullback right there. Apple was a company that I mentioned yesterday to my premium members in the morning in my swing trading class as a potential bearish setup because of the bearish near-term divergence that was taking place on it. I said you have to be awfully brave to do it because the trend is certainly higher, but there were some markings on the chart that suggested we're probably due for a little bit of a pullback, and I know David probably discussed that with you last night when he talked about the bearish trade that he presented on Apple as well. So Apple was down 8% today. Microsoft was down 6% today. It's a $1.6 trillion company. Amazon is a $1.6 trillion company. It was down 4.6% today. Google was down 5%. Facebook was down 3.7%. Some really ugly moves, right? And NVIDIA, of course, has been one of the more popular growth stocks of our era. It was down 9% today as well. You have to kind of strain your eyes to look for anything that was up. And there were a few things here and there. Some of the travel stocks, surprisingly enough, were up a little bit today. And, maybe a few of the financials and some of those companies that had kind of been left in the dust in the past, we saw a little bit of a rotation into some of those names. Real quick here on the index watch, wanted to also show you from a breakdown perspective that of the 500 stocks in the S&P 500, only 55 of them advanced today. But that's not nearly as bad as it probably sounds. Typically, when we have a day that is this type of a washout day where you're looking at like a 4% decline, you actually see the ratio even worse than this is. So there were some companies that managed to hold up today, and the story is kind of being overwhelmed because of the massive percentage decline as a result of the mega cap techs like your Apples and Microsofts doing so poorly. Remember, that masked a lot of the weakness within the market when those companies were going up in recent weeks and months. And today it was kind of the opposite effect, where those very companies masked the fact that there were actually some bullish elements hidden within the market. In fact, one of the things that I had tweeted out first thing in the morning, now this was before I had gone into my class. So this was, as you can see, 7 hours ago. So this would have been like the first hour of trading here today. But it was kind of interesting to me. I said it's early in the trading session. This could change in a heartbeat. But I find it interesting that the dividend-focused ETF DVY is up over 1% on a day when the NASDAQ and the S&P 500 are having their worst days since early August. Now, that was before the rug really got pulled out and turned out to be their worst day since June when it was all said and done. But the point is, a lot of those dividend stocks that had been left for dead early in the session were actually rising, some of them rising substantially. Now, they did eventually sell off as well, but even at the end of the day, they held up a lot better than a lot of those MOMO trades, the momentum trades that focus kind of on the work from home theme. Also, while we're over here on the internet, I did want to take a moment to say thank you to the 104 of you that clicked like for me on Twitter the last time I did this video. Since we're up and over 100, we'll make sure that this video tonight will be a half an hour version. Remember, if that number is up and over 100, it means that I'll do a full half-hour version the next time I do the video. If it's less than 100, then I'll just do the 15-minute version, kind of an abbreviated version. So for those of you that like kind of a more abbreviated 15-minute version, don't click like. For those of you that like these longer format 30-minute versions, then all you have to do is click like for me there. Remember, it's pinned to the top of my timeline on Twitter itself, or you can actually click like while you're watching the video on our website, as well as we have the little Twitter link directly below that video there. Anyway, back on over here to the charts now. Now that we have kind of a lay of the land, let's take a look at a few other charts. I wanted to, since it's on my mind real quick, show you the 6 grid, the factor 6 grid. As I mentioned here a moment ago, we actually saw outperformance out of the dividend yield factor today. Now, it was still down. Early in the session, actually hit a new multi-month high. And that was different than most of the rest of the market. Value did the same thing. So value and dividend kind of shared that same element where they both ticked a multi-month high early in the session. Both value and dividend yield doing quite well in the first hour or two of the session today. Some of the banks actually held up pretty nicely today after not really participating in the rally much in recent sessions. So by the end of the day, they did sell off. You can see dividend yield actually was the best relative performer of these 6 factors today. It was down 1.6% in the end, but considering the fact that the momentum factor was down 4.8%, you're feeling a little bit better if you have a smattering of dividend stocks in your portfolio, kind of, again, counterbalancing things to a degree. If you're going to ride the lightning, so to speak, with all of those wild momentum stocks, your Zooms and your DocuSigns and your Teledocs and all those fun stocks that have been doing so well, then you're going to have to absorb a blow like today. And today did hurt for those types of portfolios. There is no denying that. That is an ugly looking candle right there. Yet it does remain above a rising 30-day moving average. Interestingly enough, over the last month, despite the massive give back here today on the momentum factor, it's basically still tied in performance with dividend yield. It just got to that place in a different format or a different trajectory, right? The dividend yield has been a more consistent plodding higher to now give us about a 2.85% return over the last month. Momentum factor is up just 2.7%, so down a little bit less than the dividend yield factor, but had been a much sharper ascent followed by a much sharper decline to get there. In both cases, prices are above rising 30-day moving averages. In fact, that's the case with all 6 of our factors here. So while today did not feel good for a lot of people that have long exposure to the market, we have to remind ourselves that we've been in a wildly bullish market for quite some time, and the economy is not great, right? This has been a disconnected stock market. We had that conversation to a degree in my question and answer session today as well, where stock participants have had it rather good compared to what is actually happening on Main Street in the real economy. So I take a day like today in stride. Did I enjoy it? No, not at all. You don't enjoy seeing stocks go down to the degree that they did, but having a few bearish trades in your portfolio, having a few dividend stocks to offset some of those momentum stocks, things like that do help on days like today. And I didn't find it particularly abnormal to experience a day like today, particularly considering, what felt abnormal recently was the rise. It wasn't today. It was the spectacular eruption of stocks like Zoom up 40% in one day, right? That was the abnormal part. Today kind of felt like it's a little bit more back to reality. Now, keep in mind that we are now in the month of September, and the first week of a month is when they release the jobs report number on Friday mornings. So you're going to have to strap in, brace yourself. There is possibility for continued volatility if the market does not like what they see from that jobs number. And I think there are just general nerves in the atmosphere right now for the sheer fact that we are heading into a long holiday weekend. All of a sudden, we're going to start having people second guessing themselves going into a weekend. Remember how that was happening quite regularly back in March and April. As we would approach the weekend, the weak hands would come out and they would just start selling their portfolio because they're thinking to themselves, I don't want to hold stocks over the weekend. I don't know what sort of additional bad news is going to come out. And so that can sometimes be an even worse feeling if you know that you don't just have to sit through Saturday and Sunday. This weekend, we have to sit through Saturday, Sunday, and Monday with Labor Day holiday coming up here, at least in the United States, where the stock market will not be open on Monday. So we want to watch out for that as well. I don't necessarily think that this is going to lead to a massive decline back to the lows that we saw back in March and April. But it would not surprise me at all if in the next several sessions, we need to flush out the weak hands a bit more. And so you have to kind of be positioned knowing that that is a possibility. And we'll talk about that a little bit more when I get into my trade application example, because, again, on Tuesday, before I knew that today was going to happen, I did a bearish trade example Today, when today has already happened, I'm going to do a bullish trade example because prices are now better for a lot of securities. Your risk reward is perhaps a little bit better, but I'm going to be offsetting that bullishness by choosing a particular security that I identify as a pretty boring, non-volatile type of a stock. So that way I can kind of absorb an additional movement lower in the overall market without really sweating bullets on my trades. We'll talk about that here in just a little bit. Before we do, let's talk about the general foregrid that I oftentimes bring up for the overall markets, because this is kind of interesting as well. What we're seeing here is bullish intermediate confirmation signals on 3 out of our 4 charts. And those 3 charts are going to be the S&P 500, which is in the upper left, the Dow Jones, that's in the upper right, and the NASDAQ Composite, that's in the lower left. And a quick refresher as to what a bullish intermediate confirmation signal is first of all, it has to start with a bullish intermediate line. Remember, on the market forecast technical indicator that you find here on the Thinkorswim platform, the green line is the intermediate line. That's kind of our default mode with these videos. If you just hear us say, generally speaking, our posture is X or our posture is Y, when we are referring to quote-unquote posture, we're talking about the intermediate posture unless we tell you otherwise. So that's kind of the main line that we look at. And that main line in the case of all of those charts that I just mentioned are still bullish because they're in the upper reversal zone. The only exception to that is down below with the Russell 2000. Notice that the Russell 2000 sell-off today was so aggressive that you actually saw the green line fall out of the upper reversal zone. The intermediate line is at 77.77 and falling. That actually sounds kind of lucky to me there. Remember that the upper reversal zone ends at 80. So when you're reading these labels, you see S&P 500 at 91, Dow Jones at 90, and NASDAQ Composite at 91. So while all 3 of those lines are falling, they're falling within the upper reversal zone. We still consider that to be a strongly bullish intermediate posture. So that's step 1, identify a bullish posture, whether it's strongly bullish or even weakly bullish. Step 2 is making sure that the red line is in the lower reversal zone. And in all 3 of those charts cases, you can see that it is. And again, you can use the labels to make that easier on your eyes. Remember, the lower reversal zone is below 20. So the momentum red line is below 20. As you can see here on the S&P 500, it's at 17. On the Dow Jones, it just barely got below it. It's at 19. And on the NASDAQ Composite, it is down there at 13. Now, you guys have heard us say that there are more ideal and less ideal bullish intermediate confirmation signals. And unfortunately, despite the aggressive sell-off that we saw in many of these charts, we still don't have the ideal setups. The ideal setups are when you get the blue line between 50 and 20. And you'll notice that the blue line settled on the NASDAQ at 54. Same thing for the S&P 500, and it settled at 56 on the Dow Jones. So in other words, we got really close. We were approaching the midpoint on that blue line, but we just didn't quite crack below 50. So it could mean that we have another day of sell-off before us tomorrow, before a really good buy the dips situation emerges. And remember, with as much of a give back as we've had right here, it would be very interesting to me to see another sell-off to this upward trending 30-day moving average. Kind of reset the deck, so to speak, and start finding a little bit of stability and support there, and then reloading the gun for more bullish trades going forward. You can see that it's done a pretty good job of obeying that 30-day moving average in the past. So until we see a major breach of that moving average, I'm going to assume that it's going to hold. Notice down below that the NASDAQ Composite's even better about that. The S&P 500 had a couple of days back here, late June, where it spent a little bit more time below. It wasn't bad, but just wanted to point out in the compare and contrast that the NASDAQ Composite was even better. I mean, the NASDAQ Composite, has barely even touched the 30-day moving average. When it even came close, like it did right there on June 29th and it did again right there on July 24th, it immediately bounced off of it. So I'll be very curious to see if we get a sell-off tomorrow on the NASDAQ Composite, do we close below that moving average? If we do, that could become a little bit more concerning heading into that 3-day weekend. On the other hand, if we have, let's say, a sharp sell-off tomorrow morning based on a bad jobs report, but then we kind of bounce throughout the rest of the afternoon and still close above that moving average, that's the type of behavior I would want to see if I want to be bullish. Remember, markets don't go straight up. It's actually not even healthy for that to occur. If you want to be bullish longer term, you need to have stability, and having a day like we saw today could actually be a healthy thing for the market if you want to see it continue to advance in the months ahead. You start destabilizing things if you start having these epic rips higher and lower, and then it kind of starts to feel like the wheels are falling off. Right now, today was an aggressive day, but we are still maintaining that strong pattern of consistency that we've seen all summer long. So I don't think it's time to necessarily sound the alarms yet. One other thing that I found fascinating before we move on to our next charts here is that just yesterday you had overbought cluster signals on 3 out of those 4 charts, like I mentioned in the intro or when I was talking about the email distribution list. So notice here we have these red dots that showed up. Here's the one down below in the lower right on the Russell 2000. Here's the one on the Dow Jones Industrial Average, and here's the one on the S&P 500. Strangely enough, it was only the NASDAQ that did not get the overbought cluster yesterday, which is kind of weird to think about considering the NASDAQ had been the leader, but just the way that things shook out with the wicks, it didn't produce it yesterday. But 3 out of these 4 charts did give you an overbought cluster signal just yesterday. And today it was followed by an absolutely disastrous type of a day for all intents and purposes, where we were down 3, 4, 5% depending upon the index. So I'm not here to say that those overbought cluster signals will work like a charm every time, but one philosophy that people implement once they start seeing these clusters show up is maybe you start pulling a little bit of your bullish trades off the table. Maybe you sell half of your position. Maybe you start selling covered calls upon your position, right? It's not to say you need to get out right then, because we've seen plenty of times where those overbought cluster signals don't really amount to anything. This is one case in point where they amounted to something pretty substantial. And had some of you started taking some bearish trades yesterday or lightening up on your bullish trades, you might have felt a little bit better when it was all said and done here today. So, just some things to think about for the next time this happens, because we know this will happen again in the future. That's the nature of the markets. We have big sell-off days like this. We have big runs into sell-off days as well. So we continue to learn from this process, each and every time. Let's go ahead and take a look here at some 12 grid analysis now. Let's do the asset class 12 grid. And a reminder that the background colors of these charts will be either green or red. If they're green, that's bullish intermediate posture. If they're red or pink, I should say, they would be bearish posture. So let's take a look at any of the major movements here today. Up at the top, we already talked about the S&P 500 and what that candle looks like. But one thing that is noteworthy regarding the international markets now. The international markets were actually not down as badly as the S&P 500 was today, but they did not extend themselves as high up and off of their 30-day moving averages. So when EFA sold off right here and EEM sold off here today, notice that the tips of the moving averages have changed colors. They've gone from green to yellow, and what that is signifying for us is that price is now below a rising moving average. So because the rubber band was stretched so far on the S&P 500, it actually fell more than those other ones today, but its moving average remains green because it's still price is still above a rising moving average. So keep your eye on that situation. Fortunately, it hasn't amounted to much in the past. You can see that we've had some instances of this yellow moving average here on EFA as an example, and it's largely been more a time to buy than to sell. Will this time be different? Well, That's why we look at these charts every single day. We have to judge that every single day. Right now, you might look at this and say, you know what? The last several times this has touched the moving average and turned it yellow. It's actually been an interesting time to maybe scoop up some of those European shares or Japanese shares or Australian shares. EEM is a little bit different because this is really the first yellow part of that moving average that we've experienced in 3 months. This has been such a hot trend over that time period. This is the first time. So we want to identify whether we're catching a bid tomorrow on EEM or not. If it looks like we are, then again, might be an opportunity to buy at a slightly reduced price compared to where we were at just a few sessions ago. In terms of other noteworthy charts here, we did have a pretty big pullback in interest rates. Now, keep in mind, this was actually 1, 2, 3, 4, 5. This is our 5th straight session of falling interest rates after it had produced an overbought cluster signal there with that red dot. So again, we don't want to make too much of it because we're sitting right on the moving average. We might just have a reversion to the mean type of a move right there, and it might stabilize around this area, but it is noteworthy to see falling interest rates, and that may have assisted some of the areas like utilities and REITs today that did a little bit better on the average compared to some of the more cyclical sectors that were out there. Also, I wanted to point out that we did have a slight breakdown in some of the commodities. You'll notice that gold was down 0.81%. So the amount that it was down was not necessarily astronomical, but the fact that it continued to fall below that moving average is worthy of paying attention to. Now, we haven't broke any major horizontal support levels yet, so we don't want to make too much of it, but let's keep an eye on these levels. If it starts breaching like where it was trading here on August 12th, and then also here on August 27th, then there could be further downside action in gold. And remember, that had been one of the superstars of the summer. It's possible money is starting to rotate out of those areas. So again, we're in kind of a make or break zone here for gold right now. And then you also see that oil did fall below its moving average here today as well. Let's take a quick look here at the sectors. And this will be chart 5C for those of you that are premium members following along at home. And as you can see, we've got a couple of, actually a few red charts on the board. One of them, if you had been listening to my presentations in recent weeks, you should be very well aware of by now, and that is the chart in the lower left-hand corner. This is healthcare. And as I mentioned, even kind of in mid to late August, a few weeks ago, which is why I took a couple of bearish healthcare trades with AbbVie and CVS Health, healthcare just has felt heavy to me. There's been something wrong with the individual components of healthcare. You're actually not seeing it all that easily when you're looking at the entire ETF of XLV, because you might have a handful of standout performers, maybe like a Johnson & Johnson and an Amgen that was added in that case to the Dow Jones, and maybe that kind of helped mask some of the underlying weakness within healthcare. But if you go through chart after chart within the healthcare space, you'll start seeing broken down charts. And today, we saw a major reversal take place in XLV itself, where it engulfed several of the previous sessions. We now have a weekly bearish posture on healthcare, as you can see with the light pink background color there. And importantly, price was damaged so much today on this ETF that it's actually below its moving average. That moving average tip turned yellow for the first time since going back here to July. So, be careful with healthcare. There are some pretty ugly charts out there if you're looking at individual stocks within that sector. Energy should surprise no one as having a bearish posture either. That has been much more obvious to the naked eye when you're looking at a chart like this. It's been trading below its moving average for really the better part of the last 3 months. Now, one thing I should point out with energy is that it is the rare sector at this moment that actually has an oversold cluster signal. This is the first oversold cluster signal on energy that we've had since right back here on July 9th. Now remember, that was followed by a very aggressive rally. It didn't lead to a trend change, and these things often don't, so we have to be careful with our understanding of clusters, but they can oftentimes lead to a reversion to the mean type of a move. And that's important information for those of you pressing your energy bets to the downside with bearish trades. It's possible we get a quick little pop back up to the moving average here on energy in, let's call it, the next couple of weeks. The other bearish chart on the board is the financials. Now the financials actually outperformed. Quote unquote, it's hard to say that a sector outperformed when it was down 1.5% today. But, you compare that 1.5% loss to the S&P 500 down 3.5%, and they did outperform, even though they were down. So yes, it is true. Their posture is still weakly bearish, but keep your eye on that situation, because it did seem like the banks were an area where money was rotating into to a degree here today, and I'll be curious if that particular trend can continue or not. Now, in terms of the worst performers here today, you're noticing that communications was down 3.4% after having their overbought cluster just last night. You also saw technology down 5.7%. So that was the clear laggard in today's session. You actually gave back about a week and a half's worth of gains in technology right there. And so that's another reminder, going back to that comment that I made earlier, that today was a horrible day for my trend trading account, which lost an equal amount of money as it gained on Tuesday, but our account value is just back to where we were on Monday of this week. So in other words, 3 days ago. In that particular portfolio, as I mentioned on Tuesday, it's a 25 stock portfolio that does have exposure to probably 5 or 6 different sectors. So there are times where I feel a little bit jealous of people that have nothing but a technology-oriented portfolio. Today was not one of those days, because if you had done that and you had been buying stocks a little bit too late in that process, you are back to where you're trading a week and a half to 2 weeks ago. Whereas if you had a little bit more of a diversified portfolio, your portfolio value might only be back to where we were trading here on Monday. But that was the real big laggard here today, was technology. You also saw discretionary get hit today to the tune of 3%. Now, one of the areas that has been impressing me more recently has been consumer staples. You can see consumer staples outperformed today. They were down 1.7%, but before they did that, they actually hit a new multi-month high here this morning. And yes, they gave back some by the end of the session, but again, notice they only went back to Tuesday's candle with their give back. Technology went back a couple of weeks. So the consumer staples are still in a pretty significant uptrend. Their intermediate line is at 90, and it's been a consistent run. Ever since kind of bottoming out here on June 26th, this thing has just been going up consistently day after day after day. You have a few red candles in there, of course, like you always will, but none of the red candles led to any significant decline in price. And so it makes me wonder if this is an area where money is rotating into, but still retains a very strong trend. Makes it a little bit different than like utilities. Utilities also outperformed today because, again, their defensiveness, just like consumer staples. But you look at the utilities chart, and it leaves a lot to be desired. It's more of a chop and slop sideways type of a chart. The consumer staples actually have an excellent trend trading chart at this moment in time. So one of the stocks that caught my eye here yesterday, some of you might have seen me tweeting about it on Twitter yesterday, was Coca-Cola. And let me go over here to chart. Let's just do 4A. Pull up ticker symbol KO. And you can see that we do have an uptrend that's in place. Yesterday was a very impressive candle to me because we broke out above that prior high back here on June 8th. So this would have been a 3-month high. So that was a pretty impressive candle that we saw yesterday. Now today, obviously, we gave some of that back. We touched a new high early in the session as we went up to 52. By the end of the day, we closed at $50.48. This is not necessarily what you want to see, but considering what had happened to the rest of the market, a 1.39% drop today looked great in comparison to what happened to the S&P 500. The other thing I would add is that where we closed today on Coca-Cola was important to me because it did close above that high from June 8th. So while the candle looks somewhat ugly with that red shape and the high or the long upper shadow there, the fact that it still closed above that breakout zone from back in June was noteworthy to me. So you can see here we still have a bullish intermediate posture on Coca-Cola with that green line in the upper reversal zone and that green background color right there. Now in addition to that, Coca-Cola, of course, is well known for paying a dividend. In fact, it's what's known as a dividend king. It has increased its dividends for more than a half a century, more than 50 years in a row. So another thing that I like to do is pull up my dividend stair-step chart and get a sense of where do we stand with that particular security to determine whether it's appropriate to be seeking out for the long term or not. And the way that you would read this is when the stock is in this blue colored zone, it is more favorable to buy for the long term because that is when its dividend yield is above average on a historical basis. You can see with that aggressive move in price recently, we are now no longer in the blue zone because, of course, most of you are aware when price rises, dividend yield goes down. So it's kind of one of those things where be careful what you wish for. If you were already in Coca-Cola, you're loving that move. On the other hand, if you were just about to get into Coca-Cola and now it took off without you, you might not feel so great about the situation. So this would not be a time where we would necessarily get excited about buying the stock outright. However, we're so close to that blue zone here that this might be a good example for what's known as selling a put. And I've already done this trade. For those of you that are premium members, you would have received the notification via Telegram earlier during the session when it got executed. But I sold the October monthly contracts, and these are the $45 puts, and the price I got filled at was 45 cents. So you basically got your 1% return on risk with that particular security. For those of you that are not familiar with the idea of selling puts, it's a bullish strategy, but it's not a wildly bullish strategy. It's kind of a neutral to bullish strategy, and particularly when you're applying it to a very boring and non-volatile company like Coca-Cola, it's not necessarily like you taking a majorly bullish stance on something. And that was by design. Again, I wouldn't be surprised if we get a few more sell-off days here in the next week until we can start stabilizing again. And if that's the case, I want to be very careful about what types of securities I'm doing bullish, or in this case, neutral to bullish trades on. So the $45 level here when we're selling puts, remember that is where you have to be on the hook for your willingness to buy that security if it goes back down there. So some of you might have been saying to yourself, man, Coca-Cola took off without me. I wish I'd have bought it at 45. Now it's sitting up here breaking out at 50. Why didn't I just buy it when it was available? Well, selling the put at 45 gives yourself an opportunity to see that happen. Doesn't mean that it will. It just means that you're going to have that opportunity. And one of two things will happen. Either Coca-Cola does fall from 50 bucks down to below 45, in which case you'll get a chance to buy it at 45 if it closes below 45 on expiration day in October, or if that doesn't happen, then you keep the premium that you just sold coming into it. So the 45 cents that I mentioned before is yours free and clear for you to do whatever you want with. And of course, you would multiply that by 100 for every contract that you do. But the point is, at least you have a little bit of a partying gift for your recognition of a stock that was once out of favor in the blue zone, that once upon a time had an attractive dividend yield, that has now gone into an uptrend. It now is considered more of a trend trading stock, no longer has as attractive of a dividend yield, but if you sell the put, you can get it back down in that particular zone. Okay, so that's our trade application for the night. Apologize for the length of this video. It's a little bit longer than I would prefer, but with today being such an important day for the markets, I felt like it was important to look at a few more of those charts and kind of walk through a bit more of my philosophies in case it was helpful for some of you. If you did get value out of tonight's video, I would encourage you to click like for us over on Twitter. That is if you want me to do the full-length version again when I'm back with you on Tuesday. If you prefer kind of the 15-minute variety instead, then don't click like, and then we'll see which side wins out on Tuesday. Tomorrow, David should be back with you. He also teaches his technical analysis class for our premium members, so make sure you're checking that out as well. And I want to wish you all a wonderful holiday weekend. I've got my fantasy football draft coming up, so very much looking forward to that, and maybe firing up the grill and enjoying a little bit of good weather while it's still here. So whatever it is that you're doing on your end, I hope it's a great weekend there for you, and we'll circle back again next week. Until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.